It is April 22nd, 2023. It's 10 a.m. in Hawaii, and we are going to do a live session today. It's going to be a very exciting one on 1031 exchanges, the do's, the don'ts, the whens, the whys, and everything else in between. Engel & Volkers is a real estate brokerage company here in Hawaii. We're a global company. So I'm a realtor, I am a broker. I do help people buy, sell, invest, relocate, declutter, and get into another home. So that is really what our brokerage company is all about. However, education to members of the public is super, super important, because the more you know, then the more you know what to do and what not to do. So when we bring together speakers like Bill Exeter, he's calling from the mainland. He's like 6 hours ahead. But what we do is we vet these speakers so that we know that when we bring the speakers to you, their content is awesome, is great. We're just bringing them because we know that this information is not going to come from a realtor, it's going to come from an expert. We're going to be having a bunch of these sessions coming on. We're going to be talking about reverse exchanges, self-directed IRAs, land trusts, strategies. Today, he is going to cover a whole bunch of that. So there's going to be a lot of stuff. Take notes, but we'll follow it up with small little other topics later on. We can go ahead and bring on Bill Exeter. We are live here on Facebook. Bill, you could pop open your screen. There we go. Aloha. Okay.
Aloha.
All right. Hey, Bill, just a really quick thing before I get into this. You have come to Hawaii a few times with your family. And what is one thing you love about this, besides the weather? What is the one thing that you got an endearment for this island?
I think number one is the people. People are just so great, so warm, friendly, accepting, etc. It's awesome.
Okay, awesome. I thought you would say like the luau or some of that. We gotta bring you to some of that. But Bill and all of you on Facebook Live, if you're hearing, and those that you are in the Zoom room, Bill has so graciously given up his Saturday, and he has family and everything back at where he's at, and he's going to share a little. But it is what did you say? 4 o'clock, almost 6 hours ahead.
Yeah, we're calling from DC. We're actually back here working or networking with some of the congressional aides and discussing 1031 exchanges.
Wow. So okay, perfect timing. Well, again, we talked about what sessions we're going to bring them back on. I know you have helped me last year and during the COVID. We're going to bring that back on. We have a 6 session. We're splitting it up to see how we can kind of dissect it. But as we move forward, maybe once a month or every 6 weeks, something depending on your schedule. But we'd like to have you definitely come back on with different ideas. So those of you that are in the Zoom room, if you have specific topics about 1031 or anything that he speaks about, put that in the chat, then we can deep dive into those in another session. Okay, take it away, Bill, and the floor is yours. We got till 10:45, 10:50 if you like. Take your time.
Okay, perfect. Thank you. Well, welcome everybody. Good morning. And if you notice, we named this Unraveling the Mystery of 1031 Exchanges. We find we get calls all the time, literally every day. And people will say things like, I talked to 3 or 4 people. I got 3 or 4 different answers. I'm really confused. What really matters? What doesn't matter? What's critical? What qualifies? What doesn't qualify? Things like that. So what I really wanted to cover is we're going to go through the basics of what is, from a compliance perspective, what do you have to make sure you accomplish to have a successful 1031 exchange transaction. But as I go through it, I'm also going to point out the areas where there's the most confusion. And the confusion really stems from opinions. So if you call 3 or 4 people, you're probably getting 3 or 4 opinions, and they all could be right. So I just kind of wanted to explain where they come from, why you get these different opinions, and what really, really matters, what's the most important thing. That way you're able to really make a better informed investment decision when you're going through your 1031 exchange transaction. So with that, real quick, I'll introduce the company to you. Those who haven't worked with us before, the company is Exeter 1031 Exchange Services. We're a qualified intermediary. Some people refer to us as an accommodator or a facilitator. We handle all types of exchanges. We cover all 50 states. And we're going to talk about forward 1031 exchanges where you sell first and then you buy your replacement property second. We're also going to briefly talk about reverse 1031 exchanges where you can acquire your new replacement property first and actually close on that and then sell your current property later, those are a lot more complicated, more costs involved, et cetera. And we'll cover that in a different webinar where we can get into a lot more detail, but we'll cover it briefly today. We'll briefly mention improvement 1031 exchanges. Improvement exchanges are those where you sell a current property, you're doing a 1031 exchange, and you're going to have some cash or equity left over, and you'd like to use the equity to build or improve or retrofit the property that you just acquired. And those, again, are also a lot more complicated, et cetera. But we'll kind of walk through those. We're also one of the few qualified intermediaries that can administer foreign property 1031 exchanges. So I want to be careful there. With a regular 1031 exchange, typically you're selling property in the United States, so you have to reinvest in property that is also in the United States. A lot of things you see or read on the internet say you cannot do a foreign property 1031 exchange. Well, that's not really true. What they're really saying is you can't sell U.S. property and exchange into foreign property, or you can't sell foreign property and exchange into U.S. property. So when you're doing the 1031 exchange, you're either selling and then buying U.S. property, so it has to be all U.S. property, or you're selling a foreign asset and you're going to exchange into another foreign asset. So that exchange would be all foreign property. So either way works, all U.S. or all foreign, but you cannot go between the two. So when you see something that says you can't do a foreign property 1031 exchange, that's what they really mean, is you can't go from domestic to non-domestic properties. And then a little bit more on the company. We're one of the few qualified intermediaries that has any kind of government oversight. Our 1031 exchange industry has no regulatory body. There's no licensing capabilities or regulatory capabilities. We wanted to be regulated, so we went down the banking path. We took a couple of years of going through the very detailed review and approval process, and ultimately got our own trust company charter. So we fall under the Division of Banking. That means we are licensed, we're regulated, and we're subject to an annual audit by the Division of Banking to make sure that we are operating in a safe and a sound manner. I've been doing this now for 38, almost 39 years, and there's been a number of qualified intermediaries over the years that have failed for different reasons. Most of those failures would have been prevented had they had any type of government oversight. So that's why we thought it was important to do that. So we went through that for a couple of years and got that rolled out. I've been personally administering 1031 exchanges, like I said, for almost 39 years. The Exeter 1031 exchange as a company has been doing it for 19 years. We've been doing it for a long time. We have a lot of experience. We've seen a lot of things, so we can help you walk through your transaction. You can bounce ideas off of us, ask questions. We're always available to help and walk through whatever your specific transaction might be. We're more consultative, more advisory in that respect as well. And we offer 24/7 access. So you can get a hold of one of our folks 24/7. Then I mentioned that we're now licensed by the Division of Banking. So our regulated entity is Exeter 1031 Exchange Services. We fall into the Division of Banking as a trust company. That means a couple of things. Number one, it means that your funds are held by a regulated entity. And it also means that each client gets their own separate, segregated, dual signature qualified trust account. That means it's a separate account all by itself. It's not commingled with anybody else like some of the qualified intermediaries do. And it's also subject to annual audits by the Division of Banking. And then real quick, what do you look for when you're shopping for a qualified intermediary? So this is a quick list of things you can ask about. I think number one and most important is that regulatory oversight. You want a third body who's looking over our shoulders to make sure that we're operating in a safe and sound manner. But you also want to look at fidelity bond coverage. Fidelity bond coverage is crime insurance. That covers you in the event there's misappropriation, fraud, embezzlement of the funds. You're insured. You want to make sure there's errors and omissions insurance. E&O insurance is to cover you in the event we goof. If there's an error, if we omit something, overlook something, what have you, and that creates a loss for you, then you're covered by the errors and omissions insurance. And then as Barbie mentioned, we offer different products because of our trust powers. So that means we can also offer the self-directed IRAs or individual 401k plans where investors want to focus on using their IRA to actually buy real estate, mortgages, deeds of trust, tax lien certificates, private companies inside their IRA as an investment. And so we can do that. We're an alternative asset custodian. We offer title holding trust or land trust. So when individuals want to negotiate, acquire, and hold legal title to real estate on a confidential and private manner, we can do that through a title holding trust or a land trust. Those are the same. They just, they're called different things depending on the geographic area that you're in. And we also do just specialty holding escrows. So if the title or escrow company is not permitted to do something because of the local regulators, we can look at different types of holding escrows to see if we can help out there. So having said that, let's jump into the actual 1031 exchange topic. This falls under section 1031 of the Internal Revenue Code. That's where it gets its name for those who aren't aware of that. 1031 exchanges have actually been around now for 101 years. Last year was their 100th year anniversary. So a lot of history there. It's really a tax deferral strategy that lets you sell your current property that's held for rental, investment, or business use, and reinvest in other rental or investment property and defer your capital gain taxes, defer your depreciation recapture taxes. So it's really designed to allow you or help you to sell your current property. And by not paying the taxes, you keep all of your equity, all of your cash coming out of the sale in your pocket. Instead of writing a check for about a third of the profit to the federal and the state governments, you're deferring it. And so it all stays in your pocket. And that allows you to trade up into larger properties, more units, better cash flowing properties, things like that. And it's all about doing that which ultimately increases your net worth. So that's what it's all about. Keep deferring the taxes over and over and over. And then it helps you build your net worth much faster than if you paid taxes as you went along. Now, we get a lot of questions about, when should I use it? When should I not use the 1031 exchange? And so it depends on you. It depends on your goals and objectives and what's right for you. Most investors are buy and hold investors. They buy real estate, they hold it. When they get to a point where they think, okay, it's time to get a larger property, maybe a larger apartment complex, or reposition in different types of investment properties, et cetera, and they want to defer the tax, that's when the 1031 exchange comes in. A lot of folks look at it as a transaction tool where you're selling one asset, you're deferring the taxes, and then buying something else. But it's more than that. It's actually a lifetime or a long time wealth building strategy. You can continually defer the taxes over and over and over. Every time you sell property, you do a 1031 exchange, you defer the taxes again. And then the benefit, the long-term benefit, is when you pass on and you leave the property to your kids, your grandkids, or whoever. It could be anybody that you leave the property to. The person who inherits the property will get what they call a step up in cost basis, which means the capital gain tax goes away, the depreciation recapture tax goes away, and all of that becomes a non-taxable event. It's all tax deferred. So the best way to look at that is, let's say years ago you bought property and maybe it was worth $100,000. Maybe today it's worth $1 million. You pass on, you leave it to, let's say, your grandkids. In that case, your grandkids will inherit the property and their cost basis is stepped up or increased to the fair market value at the date of your death. So your original cost basis was $100,000, but when you passed, your property was worth $1 million. So their cost basis is increased to $1 million. They could now sell the property the next day. They'd sell it for $1 million. Their new increased cost basis is $1 million, so they pay zero capital gain taxes. So that's really the long-term benefit of the 1031 exchange. You could certainly cash out along the way and decide to stop 1031 exchanging and just pay the tax. Some people use it to slowly work out of real estate. So every year they'll sell one and do a partial 1031 exchange. We'll talk about that. But if you say sell for $1 million and you buy for $800,000, you're trading down by 200,000. So that 200,000 would be taxable, but the rest would be tax deferred. So you'll see a lot of things on the internet that say you have to trade up in value or equal or up in value. You have to reinvest all of your equity. You have to replace all of your debt. Well, that's typically true if you want to defer all of your taxes, but it doesn't necessarily mean you have to. Some people will do a partial exchange. We'll get into more details on that. So remember, you can exchange throughout your lifetime. You're continually deferring the taxes. 97% of our clients do what they call a forward 1031 exchange. People also refer to them as a delayed exchange, a tax deferred exchange, a starker exchange. Those all mean the same thing. With the forward 1031 exchange, you're selling your relinquished property first, and then you have your 45-day and your 180-day window to identify and acquire replacement property. So you're selling first, buying second. And that's, like I said, is 97% of the transaction volume. Reverse exchanges are the opposite. You can actually go out, negotiate, acquire, and close on the purchase of your new property first. So you're buying your replacement property before you sell your relinquished property. And then you have that 180-day period to actually sell your relinquished property and close on that sale. These are a lot more complicated. A pure reverse exchange, which unfortunately does not exist, but a pure reverse exchange would mean you could go out, purchase the new property, take title to the new property, and own both that and your current property at the same time, and then later sell your current asset that you're trying to sell or dispose of. The IRS does not permit that. You can't own both properties at the same time. So what they've done is set up a kind of what we call a parking arrangement. It's under a revenue procedure that the IRS has issued. And that revenue procedure allows us to acquire and hold, or what they call park, legal title to the property on your behalf. So when the replacement property closes, we take title. That triggers your 180-day window in which you have to sell and close on the sale of your current property. The benefit is that you're closing on the new property first. You know you have your new property locked up. You don't have to worry about whether or not you're going to be able to find it because you've actually closed on it. And then you've got 180 days to sell that. The downside is they're much more complicated because we have to hold title to the property. That creates some complexities to the transaction. The documentation is more complex. If there's a lender, traditional lenders typically don't like reverse exchanges because we're holding title to the property. So lenders can be a little bit more challenging, et cetera. But it does eliminate the risk, not all, but some of the risk in the 1031 exchange. With the regular forward exchange, you're selling first, you've triggered your capital gains, so your taxable gains have been triggered. And as long as you can identify the replacement property and then close on it within those time frames, you defer your tax. But if for some reason you can't identify or acquire replacement property, then unfortunately the tax has already been triggered and it becomes a taxable sale. Where the reverse exchange, you're buying first, you haven't sold anything. So if you can't find a buyer for your relinquished property, there's no tax consequence, but you've gone through a complicated transaction. So it depends on what's right for you, and we'd be happy to kind of walk you through both depending on what your transaction looks like and help you decide which might be the better way to go. Reverse exchanges are about 3% of our transaction volume, and that's because of the complexities and the costs and things like that. The improvement exchanges you don't see a whole lot of. With improvements, you sell your current property. You've got your 45 days to identify what you're going to buy and to identify what you're going to construct or improve on the property. And then you have the rest of the 180 days to actually make the improvements. That's why it's tough, because in 180 days, which is 6 months, you have to identify the property, acquire the property. We have to take title to it, just like the reverse exchange setup. We have that parking arrangement. And then you have to get any permits you need and permissions and all the parties lined up, and then make whatever improvements you can during that 6-month period. And all of those things take a lot of time to get lined up. So the improvement exchanges are very difficult to accomplish. So that's a quick overview of the 3 different types of exchanges. Let's get into the actual requirements and mechanical steps to do a 1031 exchange. So first, you need to get the 1031 exchange set up before closing occurs. So if you've sold the property, you can negotiate, you can go under contract, you can open escrow, but you need to make sure the 1031 exchange is set up and in place before the closing of the sale occurs. And the reason for that is the purchase and sale agreement is assigned to the qualified intermediary. The qualified intermediary steps into your shoes. We become the seller on record. And then when the sale closes, the funds are wired to us and we deposit that into your 1031 exchange account. That's what allows you to defer the taxes. If the 1031 exchange has not been set up prior to closing, when the closing occurs, you as the investor or property owner, you actually have the right to receive the proceeds. And at that point, unfortunately, it's taxable because you have the right to receive the proceeds. So even if you tell escrow, don't disperse the funds, I'm going to do a 1031 exchange, it's still taxable because you already have the right to receive the proceeds. So it's important to make sure that you get the 1031 exchange set up before closing. And the qualified intermediary really does three things. One, we draft the documents to structure the 1031 exchange. We're going to receive and hold or safeguard your funds as part of your 1031 exchange in that separate segregated qualified trust account. And third, which I think is really important as well, a lot of companies don't do this, but I think it's important to be available on a consultative basis so that you can bounce ideas off of us. We can work with you and your advisors. We plug right into your team of real estate advisors to walk through whatever the 1031 exchange transaction is. So that kind of gives you an overview. I've kind of touched upon safeguarding funds, but I want to bring this up again because our industry, like I said before, has no regulatory capabilities. Qualified intermediaries are not licensed, they're not regulated, they're not required to be bonded or have any kind of minimum equity capital requirements. Anybody can set up shop and be a qualified intermediary. And so it's critical that you know who you're working with and that they've got the financial strength and the safety and the security behind them so your funds are safe and you know you're comfortable with that. So I think number one, the most important thing to look at is, are they regulated? You know, who's watching over their shoulders? Number two, do they have bonding? We talked about the errors and omissions, the fidelity bond, et cetera. That's critical because everybody's human. Every now and then somebody's going to goof. If they do, we want to make sure that you're fully insured and bonded to protect you. And then finally, we mentioned these separate segregated dual signature qualified trust accounts. That is critical to make sure your funds are held as client trust funds in separate trust accounts and not in the corporate name. A lot of qualified intermediaries hold your funds in their name, their corporate name, which works. That's okay. It's okay to do it that way as a 1031 exchange. But if something happens to them as an entity, as a qualified intermediary, your funds will become part of the corporate assets if they end up in bankruptcy. So it's critical to have that qualified trust account set up and in place. Okay, with that, let's go kind of through more mechanical steps. This is probably the most important slide of the presentation, and that's the qualified use. So any of the properties you're selling and the properties you're buying through your 1031 exchange have to be held for some type of rental, so rental income, lease income, et cetera, cash flow, or it has to be held for some type of investment. So you can buy real estate and just hold it for capital appreciation. Contrary to what you might read out there on the internet, it does not have to produce cash flow, but it does have to be held for investment. So for example, some people will go out and exchange into dirt, raw land, and then hold it for capital appreciation. And maybe 5 years later, 10 years later, they sell it after it's grown in value, and that's their capital gain. So buying land or any other kind of real estate and holding it for capital appreciation will qualify. And the third category is business use. So you could buy real estate that you intend to use in your trade or business. The key there is your intent. You have to have the intent to have property, both the one you're selling and the one you're buying, that you're going to hold it for some type of rental, investment, or business use. That's where the confusion comes in, because what exactly does that mean? It sounds pretty straightforward, but it's not. So you'll hear a lot of people say, it depends on how long you've held title to the property. That's kind of true. This is where those opinions come in and it gets a little confusing. So here's the real issue. The tax code, the regulations, and the rulings have no holding period required. There's nothing that says you have to hold title for at least 1 year or 1 year and 1 day or 18 months or 24 months. And those 4 timeframes are typically the opinions you get out there. What the regulations do say is you have to have the intent to hold for investment, rental, or business use. That's all it says. Now, the best way to prove intent if you get audited is to do just that, is to hold the properties for rental or investment purposes. So that's why people get hung up on the length of time. The longer you hold the property as some type of rental, investment, or business use, the easier it is to prove that was your intent. But it doesn't have to be long-term, and even long-term doesn't guarantee that it would qualify. So let me give you a couple of examples. First of all, it all boils down to intent. If you get audited, can you prove your intent was to hold for investment purposes? So there's 2 tax court cases. Both were unrelated, both were developers, both bought dirt, both intended to build single-family homes and then sell like developers typically do. In these 2 cases, neither one built anything. One developer held their dirt for 12 years. The other developer held the dirt for 20 years. Both ended up selling without building. Both did 1031 exchanges and both got audited and both were disqualified because their intent was to buy, build, and sell. So their intent was to hold for sale, not hold for investment purposes. And that's exactly what it boils down to. Now, somewhere in the middle there, had they said, you know, the market has changed, my business model has changed, whatever it might be. Recently, a lot of things got changed because of COVID. So COVID changed my business plan, something like that. And if they had started reporting the property as held for investment instead of held for development, and they could show that and prove that under audit, their exchanges would have qualified. All they have to do is change the way they reported on their tax return, probably for at least a couple of years, if not longer. And now they report it on Schedule E as property held for investment on tax returns, on financial statements, on mortgage loan applications, things like that. They listed as property held for investment. Emails back and forth between the real estate broker, their attorney, their tax advisor, us as the qualified intermediary. If the emails show, hey, my intent has changed, what do I do? How do I depreciate it? How long do I hold it for this, etc.? Emails can be used to help prove your intent had changed, and that's one way to do it too. Although be careful, emails can also be used against you. So if your email says, I intended to sell it, I intended to hold for sale, I intended to move into it, all of that can be used against you to show that it really wasn't qualified use. So to kind of summarize, I should back up real quick. So there's one case that we worked on with one of our clients. They did a 1031 exchange, they bought a condo. They did not read the CC&Rs until after the close of escrow, unfortunately. Quickly found out that the property had to be owner occupied. It could not be held for rental purposes. So in this case, they quickly found out it had to be held for owner occupied. They didn't want that. They quickly sold. They did another 1031 exchange. And as luck would have it, they were audited. And their 1031 exchange was actually allowed, even though he held the property for about about a month and a half. They allowed his 1031 exchange to qualify because he could prove his intent was to hold for rental, but there was a business reason why he couldn't, and he had to reposition into another property that he could hold for rental. So even a short-term holding period will qualify. So investors who are in the business of developing or building, or they're a contractor, maybe they're a condo conversion specialist, maybe they're a rehabber or flipper, all of those investors typically buy, they do something to the property and they sell. Their intent is to buy, do something, and hold for sale. So they don't qualify for 1031 exchange treatment. Now, if any of those folks were to buy, do something to the property, and then hold it as rental, it would qualify. So it's all about what intent you can show. And if you have any questions on that, happy to take questions along that line and kind of dig deeper if you'd like. We kind of covered this. So the holding period is not specific. There's nothing that's required. You just have to make sure that you can prove your intent. But that's why you get these opinions. Hold it for at least a year and a day, 18 months, 24 months, et cetera. That helps prove intent, but it's not the end all. The same thing goes for like-kind property. A lot of confusion out there. There's still a lot of curriculum that I've seen online and in person where they say, if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments. That is absolutely not true at all. Like-kind property means you're selling real estate, you have to buy real estate. Any kind of property qualifies. As long as it's real estate for real estate and it's all held for rental, investment, or business use, it will qualify. So I'm going to jump down here and go to like-kind property. So all of these are considered like-kind to each other. You'll notice it includes things you wouldn't even think are considered like-kind property, but air rights, water rights, mineral rights, certain types of oil and gas investments, fractional ownership, whether it's a tenants in common arrangement or it's a Delaware statutory trust, those qualify. You can sell a single family home, you can buy commercial office or retail, you can buy vacant land, dirt, any of that qualifies as like-kind property. Are there? Non-like-kind property, this is probably just as important. So anything that you use as, primary residence, second home, vacation home for personal use, they're not going to qualify because it's not held for rental or investment, it's held for personal use. However, you can change that. So you could stop using it for personal use, start renting it out, convert it to rental property. In this case, because you did use it for personal use, I'd probably recommend renting it or holding it for investment for 2 years. 2 years straddles 3 tax periods. Really solid proof that's what you intended to do. That's not a requirement, that's my opinion, but it's more conservative, and if you end up in an audit, it's much easier to prove that you did intend to convert to rental use. So that's what's really critical there. This one gets really complicated when entities are involved, so I don't want to dig too deep, but just want to bring it up. Many investors will pool together and have 2 or 3 or 4 or 5 investors or more join together to make an investment. Probably the most common strategy or structure today is to use an LLC. So you may have 5 investors who invest in the LLC. They put money in. They each become a member of the LLC. LLCs that have more than one member are typically treated as a partnership for tax purposes. So it's an LLC that's treated as a partnership. That's great for pulling your resources and accounting purposes, filing a tax return, but it complicates the end game when you decide to exit the property. It's important to note you as individuals don't own real estate. You own a membership or a partnership interest in the entity, and the entity is actually selling the real estate. So the entity, if everyone's going to stay together, that's easy. The entity could sell, the entity could do a 1031 exchange and reinvest and defer the taxes. But in many cases, the individuals want to go different directions, and that's where it gets complicated, because typically the individuals are just receiving a cash distribution out of the partnership, and that doesn't qualify for 1031 exchange treatment. There are many ways to potentially solve that situation. So the message here really is, if you are with an LLC or corporation or some other entity that has multiple investors and you don't want to stay with them when you sell down the road, now's the time to talk to your advisors and figure out how you can restructure that so you could do your own thing later down the road. And I'd be happy to chat with you about your specific situation. Just let me know. I'll be happy to do that. Okay, there's specific identification rules, and many of you have probably heard about these already, but when you sell your property, the closing of the sale is what triggers everything. So if you close your escrow today, tomorrow's day number 1, you have exactly 45 calendar days to identify what you're going to acquire. That's the tough part. That's what moves really, really fast. So you want to make sure that you've got your identification and everything kind of ready to go. Start looking for property as soon as you possibly can. The earlier you start looking, the safer it is, because ideally you want to have something identified, probably under contract. It takes a lot of the risk out of this forward 1031 exchange. If you wait till you're in the middle of your 45-day window and then you start looking for property, it gets very stressful and you don't have a whole lot of time to find the property. Keep in mind, the 45-day period only starts running when you close. So if you can get the buyer to extend the close of escrow, then you've extended the start date for your 1031 exchange, and that buys you more time to look for replacement property. So look for property early, try to find a way to extend the close of escrow, etc. If you find replacement property that you want way before you've sold any property, the same thing. See if the seller's willing to wait and delay so you have time to get your current property on the market, sold, closed, and then you're ready to close on the sale or the purchase of your new replacement property. So it's all about timing. Then you get an additional 135 days after your 45-day identification period to complete your purchase. So you get a total of 180 days, 45 days to identify, an additional 135 days to complete the exchange, for a total of 180 days. Be careful, it's not 45 plus 180, it's a total of 180 days. Identification rules, this gets a little complicated, so I'm going to kind of go through it, and then if you have questions or on your specific transaction, I'd be happy to chat. There's really 3 rules. By far, the most investors are using the 3 property rule, which means you can identify up to 3, but not more than 3 properties. Most people identify 3 with the intent to buy 1. The second and the third identified properties are just backup. And if the first property for some reason can't be acquired, you can't close on it, you can look at the second and third property as backup strategies. That typically works in a normal market. We're not in a normal market today. Markets are moving quickly. There's not a whole lot of inventory. In some geographic areas, we're starting to see multiple offers again. So the second and third property may be long gone, but that's the intent of the 3 property rule, is you've got backup ID properties. If you're looking to sell one large property, a large asset in terms of value, and then you want to go reinvest but diversify in a bunch of smaller properties to spread your risk around, you're probably going to look at the 200% rule. Somebody is a client that did this recently, just to give you an example. So we had a client who sold, it was a $4 million sale. He wanted to diversify and he wanted to get out of those expensive markets. So he sold the $4 million asset. In this particular case, he sold it in Orange County in California. And he wanted to go back and buy a whole bunch of single family properties in Tennessee. So under the 200% rule, you take your sale price, which in his case was $4 million. You can double that to 200%, so that is $8 million. Under that rule, he can identify as many properties as he wants, as long as the total value of what he identified does not exceed $8 million in that example. So he went back to Tennessee and he identified 56 different single-family homes. He wasn't going to buy all those, but he identified 56. That way he's got a lot more to look at, do the due diligence on, and then choose from. He ended up buying 23 of those single-family homes, which allowed him to trade up in value, diversify from 1 property to 23 properties, and that was a great strategy for what his goals and objectives were. So that's where you use the 200% rule. The 95% exception is just that. It allows you to say if you identified more than 3, you identified more than 200%, you're going to be okay as long as you actually purchase and close on 200% of the value. So let's say you identified $10 million worth of property, you would have to close on $9.5 million in total value. You want to be careful with that. That's really designed for purchase of a portfolio type property. Like if you're providing 40, 50, 60 homes. We had a lady a few months ago who identified 40 homes. We called her and said, that's way over 3 properties. It's way over the 200% limit. And she said, that's okay. It's a portfolio. I am buying from 1 seller, 1 contract, 1 closing. I'm either buying all or nothing. And so she closed on that. She purchased all 40 properties. That means she bought 100%, and that falls under the 95% exception, and she qualified. The other area we get a lot of confusion on, a lot of things you read on the internet sound like you have to reinvest your equity, and that's all, your profit, your cash position, et cetera. None of that is true. So the question is, how much do you have to reinvest? The answer is, it's the top line. So let's say, going back to my other example, let's say you sell for $5 million. You are allowed to subtract your routine selling expenses, broker's commission, title escrow, etc. If you subtract those, your net sale price is probably around 4.8 million, give or take. That's the magic number. That's how much you have to reinvest. So whether you buy one property or multiple properties, as long as the total of what you purchase is equal or greater than about 4.8 million, you've traded equal or up in value. You've satisfied the top line requirement. The government's really telling us you've got this asset worth a net of about 4.8. And as long as you reinvest, or I should say stay reinvested or stay invested at that level or higher, they let you defer all the taxes. You also have to reinvest all your equity. So everything that comes out of the sale, all your cash has to be reinvested. And then typically most investors will replace the old debt that was paid off on the sale and get a new loan on the new property to make up the difference. So you've traded equal or up in value, you've reinvested all your equity, and you've replaced your debt. And that's where you will say, I've traded equal or up, and I've satisfied all the requirements, and I'm fully tax deferred. As I said before, you can trade down in value, so that's okay. Trading down in value is not a problem. It's referred to as a partial 1031 exchange. You can pull cash out. Does not hurt the 1031 exchange, but if you trade down in value or you pull cash out, it will be taxable. The amount you trade down by and not reinvest, the amount of cash you pull out that's not reinvested is taxable, but everything else would be tax deferred. So it's important to note that it's okay to do partials. A lot of things on the internet say you can't, that you have to trade equal or up, you have to reinvest everything, etc. But that's if you want to defer everything. Why would you do that? Well, a perfect example is you should always meet with your tax advisor first. Find out if you have a net operating loss carry forward from the sale of some other asset, a sale of a business, a sale of stocks or bonds. Or maybe you have a suspended passive activity loss from your real estate. And if that has been building up, you may be able to just trade down in value, trigger that suspended passive activity loss that could offset some of your taxable gain. So sometimes you can do a partial exchange and still pay no taxes. There may be something else on your tax return. You may have some tax credits. So always talk to your tax advisor to make sure you've covered all of those bases. And with that, this will be the last slide, and then we'll turn it over to Barbie and everyone for questions they may want to ask. Just to kind of have an update on today's market, legislative trends. I'm back in DC right now. Like I said, we're talking to a number of congressional representatives to make sure they know what 1031s are all about, how they work, et cetera. So on the 1031 exchange front, in 2021, the Biden administration proposed a lot of things at the very early part of 2021. They kept getting changed. When the dust settled, what they had proposed is limiting the amount of taxable gain that you can defer to $500,000 per person per year. For a married couple, they could defer $1 million in taxable gain per year. Our objective there was to keep that out of the bill, so it was never introduced to Congress, and we were able to do that. So the bill never included that provision, and the bill died in the Senate anyways. In 2022, they proposed the exact same thing, the same limitations. Because of the makeup of Congress, that never happened. So it didn't go anywhere. We didn't really have to do a whole lot. Here in 2023, again, they issued their green book, which is kind of like the proposed budget, their wish list of what they want. And again, it includes the same proposal to limit the deferral of capital gains to $500,000 per person per year. Same issue. We think that it's not going to go anywhere. Congress is, kind of separated now, where the Senate's under the Democratic control, the House is under the Republican Party control, and that helps balance everything out. Balance is always a good thing. So we won't see anything that's really crazy. We don't think that's going to go anywhere either. But we're back here talking to people to make sure they know how it works, because that's critical. They had proposed in the past the elimination of the step up in cost basis that we talked about. That went nowhere, and it's not in the current proposed budget. They had proposed changing capital gains. That is not in the proposed budget. They were eliminating some of the provisions in self-directed IRAs to make it very difficult for investors to buy alternative assets in IRAs. That was taken out, so that also is not included. So today we're looking pretty good. We don't have any major threats on the horizon, at least no major threats that we think are going to go anywhere. So that kind of gives you a quick overview. And with that, Barbie, I'll turn it over to you and see if there's any questions that I can answer for everybody.
Okay, well, thank you so much. Wow, every time you come on, I learn a whole bunch and then more. You had one slide that you had when you had sent me, that was the special tax planning about the combining 1031 and 121. Is that something you can?
Oh, you're right.
Yeah.
Yep, I think I jumped over that. Let me back up here.
No problem. Okay,
Yep,
here.
there we go.
Okay, I'm gonna mute
Perfect.
my.
I'm glad you brought that up. I missed that. Yep, absolutely. This is one of my favorite slides, actually, so shame on me for missing it. And I'm going to use a client as an example here. We had a client, this is in La Jolla, California, where they bought a property 42 years ago. They lived in it for 42 years as their primary resident. They were having health issues. They wanted to go back east where their kids and grandkids were. But they kept telling their family, I can't sell, because their capital gain on the property was $8 million. And had they sold, they would have gotten $500,000 tax-free because they could say they've lived in it for at least 2 out of the last 5 years. In this case, they lived in it for 42 years. But the other $7.5 million in gain would have been taxed, and that would have been brutal. So when we got introduced to them, we said, look, there's actually an IRS ruling where you can convert your property to rental, investment, or business use. And then as long as you show your intent to convert that, ultimately you qualify for both. You would still get the $500,000 tax-free exclusion, but you'd also get to do a 1031 exchange and defer the other $7.5 million. So ultimately what they did is immediately move out of the property. They moved back east with their family. They immediately converted the property to rental property. We suggested a 2-year rental so that it was very conservative and it was easy to demonstrate they intended to convert to rental. And then at that point, after the 2 years, they sold the property. That gives them another 1 year to actually close on that sale. And they did. So once it closed, they got $500,000 in tax-free gain, and they deferred the other $7.5 million into multifamily property back on the East Coast. So the key here is you're combining what we call the 121 exclusion, or section 121 of the tax code, with section 1031. And it's the kind of the win-win. It's the benefit of both worlds. The key is the day you move out of the house and convert it to rental property triggers a 3-year window. During that 3 years, you have enough time to rent it out to show intent, and then you can sell and close on the sale. If you pass the 3-year window, you can never say you could never say I lived in the property for 2 out of the last 5 years, because now you passed the 3-year window. So if you look back 5 years, you actually lived in it less than 2 years. So you lose the $500,000 tax-free exclusion. It's not the end of the world, perhaps, but $500,000 tax-free income is really nice. So that's the best way to take advantage of that.
That's awesome. Yeah, that is one of the biggest things, especially here in Hawaii. A lot of the properties are worth way more, right? You buy it at 35,000 or 50,000 or so, and now it's worth 1.5, or huge. So tax planning, tax strategies are super important. But I think, Bill, thank you, because I think most important is who you're working with. Because a lot of people can say, I can do a 1031, but this intricacies and these details, if it's missed, can actually mess up, like you said, the 1031. So making sure that, especially you that are on our Zoom room or on Facebook Live, it doesn't have to be us or Bill or anything, but make sure that you know who you're working with. And please give us a call if you have a question and you just don't know where to start, but you have the property and you just don't want to leave money on the table. You want to make sure you do it right, and timing, super important. So Bill, I see that you have your information here. They can get in touch with you, or they can also call me, and I can certainly set up that for them with you, right? Is that true?
Absolutely, yep. And Barbie, I think we're all going to be out there together. I think it's May 15th, 16th, 17th, and 18th, as I recall. So we can also, if they want to meet in person, we'll be there. We can meet in person.
Okay, perfect. You know what? We'll probably set up like a, I know that our company is going to do something, but we can also set up something a little smaller, and then we can have whoever is on our Zoom room right now, or we'll put you guys together. So perfect. That'll be great. Okay, I'm going to keep in touch with you, get you over to Zippy's or something, or maybe something nicer. Okay, get you some Hawaiian food or something. Okay, but Bill,
perfect.
but before we get off of Facebook, I don't see any other main questions here that we could get off, and then people can ask a couple of more questions. But one of the things is I had addressed to me is, can a 1031 be bought and a daughter or close relatives live in it? So if you're buying, see, I think the question was posed, if you buy a 1031, if you do a 1031 and a relative, a daughter or something wants to live in it, is that okay? I mean, how does that work? And
Good question. And it depends. That's my favorite answer. I know people hate that. But it depends. It is absolutely possible. Contrary to what you'll see out there, people will tell you you can't rent to a related party, and that's not true. You can. You can absolutely sell property, do a 1031 exchange, buy replacement property, and as long as you're renting the property to the related party, it's like any other tenant. So it does have to be fair market value rent. But if you don't rent it to them, if you let them live in it, so it's rent free, then it becomes a second home or second residence, and you're allowing a related party to live there for free. It would not qualify. So the key there is rental and demonstrating that it was held for rental purposes. The same thing can be done. We get a similar question, which is, can I do an exchange, buy replacement property, and when can I move into it? And the answer is, you got to be careful. Your intent has to be to buy and hold the new property for rental. I'd recommend 2 years, which again straddles 3 tax periods. I think that's very conservative. And then after that, your intent can change. So you could certainly get rid of the tenant and move into it and convert it to your primary residence.
Okay, and actually, I'll tag onto that what you just said. The other question was, and then how long would you have to, once you do that, you move into a 1031 exchange property, and then you kick out the tenant, and then you move in. How long do you have to live in it for it to become your principal residence, so that at the end, when you're ready to sell it, can you use that that IRS 121, that primary residence exclusion? Can you use that at that time?
Good question. Yes, and that's changed over the years. So it used to be we tell people just move into it, and after you live there for 2 years, you get the 500,000 tax-free exclusion. Congress has come back a number of times and said that's not what it's designed for. It's not supposed to give you tax-free income on your investment property, but you can still get there. So the way they've changed it now is you sell property, you 1031 exchange into replacement property. Let's say you rent it for 2 years to be safe, and then at that point you move back into it. They prorate the gain. So they prorate the gain between the 2 years that you rented the property versus the number of years that you actually live in it. So let's say you live in it for 8 years. So you had 2 years of rental, 8 years as a primary residence, 10 years total. That means 80% of the taxable gain would be tax-free up to 500,000, and 20% would be taxable because it was 20% rental. So the longer you live there, the more income becomes tax-free.
Huge avail. That's great. Thank you so much for clearing that up. And again, things change, the tax laws change, right? So this is what it seems like today. But again, the members of the public out there, if you're watching Facebook Live, do your homework also, right? Make sure that you check with your tax accountant, see how that affects your taxes. Bill, as you notice, a lot of years and years of experience, a lot of just examples, and this is probably the tip of the iceberg. But I really enjoy having you, Bill. Every single time I'm learning a lot of new things. So what we're going to do is we're going to go ahead and get off of Facebook. But before we do that, I'd like to, again, I'm going to stop sharing, or if you can stop share screen, and I'm going to do another winning. Let's see. Okay, good. All right. We're going to do another random name picker for those of you, if you can see this. Yeah. Okay. So I took off some of the names that aren't here. So, but if you are here, I'm hoping that you won something. Again, it's a $25 gift card. And congratulations, Daryl Tamura. So one more time, hoping that we get someone on. And we got Edwina. Edwina Suzuki is definitely on. Again, a frequent flyer person. She's always been on our Zoom. I love it. Love you guys coming on. Continue to stay with us. We're going to have a lot more educational things in person and in Zoom.